Hi, everyone. I'm Martin Blemo. I'm an associate professor at the TD School. That's the Transdisciplinary School at UTS. And today I'll talk to you a little bit about raising money. So there are a couple of reasons why you'd want to raise money. One is you haven't reached break even yet. That means you're not earning as much money as you're spending. Sometimes you hear the term, how long is your runway? That's basically the time you have until you've used up all the available cash and you run out of money. Then there might be temporary gaps where you might need a bit of extra cash to get over to the next milestone or the next hurdle. And even if you've got break even, if you've made it a few hurdles, you might want to grow as quickly as possible to be the first to dominate a market, sometimes referred to as blitz scaling. And there are different types of money available for different reasons. So in this session, we'll look at the first couple of reasons. So venture capital, seed capital, friends and family. Those are usually growth capital. I'm going to get focus on those today. Then there are grants, revenues, including pre-sales, which is effectively crowdsourcing, and debt. What we won't cover today are some of the more newer forms, such as SPACs, special purpose. I can't even remember what the AC stands for. RTOs are reverse takeovers to get into a public listed company without actually having to list yourself. Distributed autonomous organizations in crypto. We won't cover those today. And some of you, if you've done the angel investing and the accelerator module, you'll recognize this diagram here too, which covers some of the basics, but in this case, we'll go a bit deeper. So funding, one highly underrated source is simply revenues, simply selling your product or pre-selling your product. So this works really well if you're early into the market, and it doesn't take a lot of investment to build whatever the machinery, whatever the IT infrastructure is, the relationships, the distribution chains. If you can get in early, even with a bad prototype, at least you're generating money to offset some of the cost to make it, and you're getting feedback. So that goes back to the lean startup methodology. Where you need growth money is for that growth and development. And when you ask for that growth capital, it's not like going to the bank where by and large you just get the money, particularly with grants too. You often just get the money. Sometimes you get some consultation in there, but not always. Growth capital, they're investing in part of your business, so they've got a stake in the game. They want your business to succeed in the short and the longer term. So what they'll give you is that capital for growth and development. They'll also give you introductions that you need to develop. So introduction to other investors, introduction to other markets, to suppliers, distributors, etc. And also the plain old good old-fashioned business advice and strategy. And as you're asking for money, they'll give you this in a reverse order too. So ask for money first, they'll start giving you advice, see how you respond, then make a few introductions, see how you respond, and then feel more comfortable actually giving it money. So we've got some core concepts to cover here. One is due diligence, series or rounds, valuations, dilution, syndication, and returns or multiples. Some we'll cover faster than others because there's simpler concepts than others. In terms of series or rounds, as you're asking for money, if you remember the angel investing module or some of the introduction here, you start off with the very early stage. So often the founder's money, then the friends and families, sometimes fools, basically anyone who will give their personal money to the entrepreneur. Then you get into seed capital, which can become a bit more professional. It might still be personal money, but it's bordering on venture capital and professionally managed funds. Then you get into venture capital, and venture capital itself can be staged into different tiers, Series A, Series B, Series C. And the level of money usually goes up almost in order of magnitude between some of these rounds. And the time scales at which this happens, is kind of along this axis here, where some series can happen very quickly, and other times there can be a lag between them. Globally, that time to raise these fund rounds is shrinking. So there's pressure to grow faster these days than there was previously in the past. The other funny bit is, if you remember the previous slide about getting advice, feedback, and referrals before getting the money, you almost want to get to know the investors you need in year 3. You want to get to know them as early as possible, build that relationship so that when you need the money, they're ready to invest. So get to know the investors basically as early and as quickly as you can. And keep an eye out for them and have them keep an eye out for you too. Tricky bit with early stage companies, particularly startups, is it's not like a factory with assets and physical resources. They're really hard to pin down. How valuable are they? How much is this business worth so that you can sell 10% of it to get some investors? There are many different valuation models. For startups, there's a pretty good series by Gust. So the link to it is up there. That's a whole nother series of modules and courses. We're not going to get into them. I just want to let you know that there are many different valuations models out there. The main thing is that you actually pick it through the logic and the rationale of like why you think you could value business using one of these methods. And then the challenge is in the negotiations with whoever you want as an investor to figure out which method works. And then for small to medium enterprises, there's some other methods too. Not one of them is a silver bullet, but do please have a look through them, Google them, and come up with the ideas on how you might be able to put a price on how much your business is worth. Which this then leads to dilution. Let's say you've got a business worth $200,000 or so, or what do we have here, $50,000? Sorry, I'm not wearing my glasses today. Forgot them at home. And you own 100% of this tiny business. Now, if you were to raise, for argument's sake, $5,500,000 from a venture capitalist and convince them to invest, you would add their money to yours and basically dilute split the equity depending on who owns how much money is in that business or how much value is in the business. In this case, that's great. You've hit the ground running. You've invested a ton of money that you can just invest in growth. You can presumably grow really quickly based on that. But the venture capitalist owns the vast majority of the business. So that's scenario A, where there's just one round of investment and you go. Relatively uncommon. The more extreme form on the slow motion strategy is scenario B, where you go through multiple rounds. So here, you might start off with $50,000. You might then raise a couple $100,000 from an angel investor. They then get a smaller chunk of the company. So you retain most of the company. Follow that, and then between rounds, if using their money, you grow, and then therefore through that growth and the new revenue streams, your company becomes twice as valuable as it was between rounds, then that puts you in a better position to raise more money. So if you then raise an additional round, another $500,000 for from the seed stage investors, then you're giving away, again, a slice of the pie. So you're growing the pie in between rounds and then giving away a slice. Follow that up with, I'll clear that top bit. Now go back to that venture capitalist and raise that same gap so that the total that you've raised in the second scenario is the same as the total in the first scenario. You see that by staging this, but in growing the pie in between raising rounds, you've actually given away much less of the pie. The founder still owns 54% of the company. So those are two totally different scenarios. Each has their draws and their benefits and drawbacks. So in both scenarios, hypothetically here, you've raised $5.55 million, but they're trade-offs. Do you raise early or do you raise over time? Do you spend time growing the business or do you spend time chasing investors for the next round of investment? So these are the kind of trade-offs that you have to figure out as an entrepreneur, and also test, I guess, the sentiment amongst the investors as well. Sometimes the money is really easy to come by, and sometimes the money just isn't there. Venture capital markets and the availability of venture capital can go through swings and roundabouts too. There are many other infographics around this. If you Google startup funding and infographics, this one comes up quite often. It's another very good one that has a bit more detailed explanation of this. Syndication we'll cover pretty quickly. It's basically that investors rarely invest alone. They often bring their friends in or are there venture capitalists that they know, particular ones that they think they might want to bring in for one round. They invite in for one round, and they know that second investor has the ability to follow on and lead the next round, and then they might want to switch places so that the other investor leads the first round, while the first investor leads the first investor leads the first round, the follow-on investor might lead the second round. So you don't want to negotiate with 10 investors simultaneously. Usually one investor will lead the round and invite their friends. And they just agree to roughly the terms and conditions of the first investor. It's a way for them to diversify their risk, and it's a way for them to take their money and spread it across more deals. Here's the kind of antidote to this here. It's like, while they do want to diversify some of their risk, they are clearly in the business of funding massive successes. They make a lot of failures along the way. So they usually want that one deal. If they only have enough money to invest in 10 startup companies, They want that one startup company who's going to return so much money that it's going to make up for all the losses in the other 9. I mean, ideally, they'd like every startup to be a total success, but that rarely happens as well. So they have to cope with many failures. That pushes them to think, okay, I'm not in the business of owning shares in mediocre businesses. So they will push a business to grow as quickly and hard as possible, or back out of it. And that might mean shutting it down, and breaking the business. And then you as a founder might then say, okay, you individually might see if you can salvage some value out of it and pivot to another business. And in some cases, that's rewarded to have failed in one business, have the experience and the networks and the associations, and then start another one. But the venture capitalists, they want to go big or go home. So that's it for me. That's it. That's a really quick overview about venture capital and startup funding and sources of growth capital in particular. I hope you enjoyed this module. I look forward to seeing you in the next one.